if you believe, a recession or low GDP growth, you might allocate to sectors that have low correlation to GDP growth. What
Hmm.
are those? Senior housing, single family rental, student housing. So you would allocate to sectors that might be less vulnerable to GDP growth. Office certainly has a high correlation to GDP growth. You might get a little bit more cautious about office. So if that was your thesis, that yes, we're entering a recession or a low GDP growth type of situation, you would sector rotate slightly into those sectors that are less impacted by GDP growth.
I think maybe to make a kind of a controversial take versus what Jim said, I would agree that in kind of a vacuum, like yes, office would be more impacted than things like multifamily or kind of specialty housing type markets in a recessionary environment. But I think the key differentiator, especially when you compare going into a recession in today's environment versus going into a recession circa 2019 or circa 2006, is that the difference in cap rates between those sectors have massively changed. So when we're looking at doing office investment now, we're talking about investing in like the mid-teens cap. So even with debt being relatively more expensive than it was before COVID, there's still much more substantial debt service coverage ratios on the office side, versus multifamily, where it's usually 1.25 or something like that. So even if there's, I agree, like the revenue is probably going to be more at risk on office. I think because of where you can get a deal done nowadays in the office sector, it may in fact be more resilient just because of your margin of safety relative to your debt costs.